Welcome back to Alpha Recap, the show where we cut through the market noise and walk you through what actually mattered today. I'm glad you tuned in after the close. As always, if you have questions, you can reach us at stockalpha.ai. Ready to dig in?
Absolutely. A lot happened on February 4th, and since the market day is over, we're going to talk about what moved stocks, what that might mean, and which filings you should be pulling tonight.
Quick high level, markets closed mixed. We saw gains in consumer staples, regional banks, precious metals and industrials, while the big tech names lagged. But beneath that broad brush was a much more interesting story. Earnings dispersion, company guidance driving the winners and losers, not a single macro narrative.
Right. The clearest examples were Supermicro and Eli Lilly. Both finished the day up after upbeat outlooks, while semiconductor names like AMD and platform plays like Uber finished down. That split tells you earnings season was creating stock-specific moves.
I love that phrase, earnings dispersion. It basically means instead of the whole sector moving together, each company's results and guidance were the dominant force. So being selective mattered. Forget broad sector bets for a moment. Stock picking paid off.
And that's important for investors to hear. When dispersion is high, exchange-traded funds can mask real opportunities or risks hiding inside. Active investors who dug into guidance, order books and forward bookings were rewarded.
Let's walk through the big names. Supermicro finished the day up after an upbeat forecast that points to sustained server demand tied to AI and hyperscale compute. If you're thinking about the AI supply chain, system suppliers that actually convert component demand into sales are in the sweet spot.
Contrast that with AMD finishing down. The weakness there reflects concerns about margin pressure, inventory digestion in gaming GPUs, and competitive dynamics in chips. The takeaway is the semiconductor story isn't uniform. You need to look at ASPs, channel inventory, and bookings at the company level.
And then there was Eli Lilly. The stock finished up on positive forward comments. Biopharma tends to be rewarded for predictability and pipeline depth, which markets like. When drug approvals or pricing commentary hits an earnings call or filing, stocks can move a lot.
Exactly. And Uber finished the day down, which highlights how investors still separate demand trends for rides from delivery and then layer on cost and profitability cadence. Those are distinct drivers, and getting them mixed up can cost you.
We also saw Sony shares get punished after the company reported a one-time non-cash charge that depressed reported earnings. Important nuance here, non-cash charges affect reported earnings per share, but they don't hit cash flow immediately. Short-term, headlines matter, and the market reacted.
That's a classic lesson in separating cash from accounting. If you're a longer-term investor, you should look through singular non-cash items, unless they're recurrent or hint at deeper issues. But traders often trade the headline, which is why you saw that move.
Shifting from earnings to flows, the day also had a rotation narrative. We saw traders rotating capital out of large-cap tech and into defensive and rate-sensitive areas. Consumer staples, regional banks, industrials, and even precious metals. That's the kind of flow that can reshuffle leadership near term.
Some market participants argued that move could persist if interest rates stay elevated, since dividend and cash flow names become more attractive. Others said it was just a tactical reallocation driven by earnings dispersion. The durability is still up for debate.
Which brings us to maybe the biggest structural story of the day, policy. An executive order from December the 19th, 2025, directed the Attorney General to expedite rescheduling marijuana from Schedule 1 to Schedule 3. That's a potential game changer for the cannabis sector.
Let's unpack that simply. Schedule 1 is the most restrictive classification. It treats a substance as having no accepted medical use and a high potential for abuse. Schedule 3 is less restrictive and would effectively open up banking, custody, and institutional channels for cannabis companies. That could lower financing costs and broaden demand for names like Trulieve, Tilray, and Green Thumb.
But important caveat, administrative rulemaking is a process. The order put the Department of Justice on the clock, but translating that into real banking access involves drafting rules, public comment, and likely some legal and political pushback. So, yes, structurally bullish potential, but the timing is uncertain.
Investors in the space should treat it like a multi-stage event. You can position, but ladder your exposure as rulemaking moves forward and details on custody and banking mechanics become clear. In other words, don't bet the farm on the headline alone.
Another technical theme today was governance and accounting alertness. There was a cluster of Form 8K filings from companies like Flex, Azenta, Bunge Global, GE Healthcare, Piper Sandler, Milestone Scientific, and others. These filings covered operational updates, officer changes, and other governance items investors should read.
Yes, those filings are where the fine print lives. If you're trading an event, you need to pull the exhibits. The article even pointed to accession numbers, which let you find the exact documents on Edgar. Those exhibits tell you whether a disclosure is routine or materially market-moving.
Practical tip. When you see an 8K, look for item 2.02 for officer appointments, item 9.01 for financial statements and exhibits. Those entries tell you if there's an earnings amendment, an unforeseen charge, or a management shakeup.
And if you're an event trader, treat the headline as a prompt to read the exhibit. The accession numbers in the filing let you zero in fast. That's how you size and time trades without getting blindsided.
We should also address where analysts disagreed. On one hand, some saw the rotation into defensives as durable if rates stayed high. On the other hand, others thought the day was a snapshot of earnings dispersion, a short-term repricing that wouldn't necessarily last.
And on cannabis, optimists believe the December order effectively puts DOJ on a fast track to enable banking and custody, while skeptics note the multi-step rulemaking process and potential legal delays. Both views are sensible. It's just a question of how quickly and comprehensively change can be implemented.
Semiconductors were another area of contention. Supermicro rallied, AMD weakened. That split underscores that the chips complex can't be summarized by a single AI or compute narrative. Execution, product mix, and competitive positioning matter, and investors should monitor forward bookings and inventory data.
So what did this all mean for different investor types? Quick run through. For active growth investors, earnings dispersion favoured a fundamental stock-by-stock approach. Look at guidance, order books, and product cadence.
For value and income investors, the rotation into consumer staples, regional banks, and industrials suggested opportunities to harvest yield and defensive cash flows. If macro uncertainty persists, those sectors can outperform.
For event and catalyst traders, the 8Ks, non-cash charges, and SPAC disclosures created tradable windows. But remember the mantra, trade the exhibits, not the headlines. Get the documents and make decisions from the source.
For long-term thematic investors in cannabis, the rescheduling directive is potentially transformative. But you should build positions gradually as rulemaking progresses and implementation details emerge.
And for risk managers and institutional allocators, tighter event risk controls around earnings windows were warranted. Sony's reaction to a non-cash charge showed that headline volatility can outsize the underlying cash economics.
Let's be practical. Action items you can take tonight. 1. Read the primary documents. Pull those 8Ks and exhibits for companies that filed today. Use the accession numbers if you want to be surgical about it.
2. When you see accounting headlines, separate cash from reported earnings. If a hit is non-cash and one-time, adjust your valuation work to normalized operating cash and recurring earnings.
3. Reassess your sector exposure. If you're tech-heavy, decide whether to lean into individual earnings winners, like the Supermicros of the world, or to rebalance towards sectors actually seeing inflows. Consumer staples, regional banks, industrials.
4. If you're watching cannabis, track DOJ rulemaking steps rather than headlines. Progress will be stepwise, and each procedural milestone matters for banking mechanics and institutional access.
5. Use dispersion to your advantage. When the market is rewarding stock-specific stories, implied volatility and liquidity patterns change. That opens possibilities for long, short pair trades, option structures around idiosyncratic risk, or concentrated buys where fundamentals are improving.
Before we wrap, a quick reminder about timing language, because this was recorded after the close. Everything we described happened today. The market moved on company guidance, policy headlines, flows, and filings. The day reinforced that headlines and primary documents drive short-term moves more than a single macro narrative.
Bottom line, in a sentence, February 4th reminded us that company-level news and policy catalysts mattered more than index-wide momentum. Earnings dispersion rewarded selectivity, flows hinted at a rotation into defensives but didn't yet make that rotation definitive, and cannabis rescheduling opened a structurally bullish possibility, if the rulemaking unfolds as hoped.
Takeaways to end on. Read the filings, separate cash from accounting noise, reassess sector exposure thoughtfully, and be patient with policy-driven themes like cannabis. If you trade events, trade the exhibits, and size positions, knowing dispersion can be short-lived.
That's it from us today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll see you next time after the close.